Have you started the recording?
Yes, the recording is up and
Oh, I
running. You
see the
can
little red
take it.
button now. All right.
Yes.
All right. Uh, all right. Well, good afternoon, everyone. It's a beautiful afternoon. I hope some of you are watching this from a deck or a patio somewhere. Um, Today, I'm going to give you an overview, well, a little more than an overview of public service loan forgiveness. Uh, Kind of woven into this PSLF presentation will be how some of the COVID waivers affect PSLF. We'll also be covering the temporary extension of PSLF. And then at the end, my favorite stuff, we'll do a little, I guess, prognostication. I'm going to talk about the elephant in the room, which is the uh, quote unquote Biden forgiveness and a couple other updates that we're seeing from a public policy perspective. So in case you're just entering the room, I do encourage you to ask questions. If you put them in the chat panel, I will take a breath every now and again, and Robert will let me know what they are. And I guess that's it. I'm going to dive right in. For those of you that aren't familiar with our organization, the Institute of Student Loan Advisors is a Massachusetts-based nonprofit whose mission is to offer free, expert, and neutral student loan advice to all consumers. So anyone can utilize our website. I'd like to think it's pretty comprehensive and in plain English. And if people have questions beyond that, they can go to our contact page and email us, and we answer most questions within a business day. We also try to help consumers with disputes. So if you're looking for a resource for your students of your alumni beyond their loan servicers, feel free to share our website with them. All right, so if you only remember one thing from this presentation, this is the slide I want you to remember, because this slide is going to answer 90% of any questions that you might have about PSLF. And the bottom line of PSLF is that you have three prongs that you have to meet, and you have to meet all three of them at the same time. So the three prongs are: you have to make 120 eligible payments. We're going to define that on eligible loans while working for an eligible employer. We're going to define all three of those things. But again, the key here is that you have to be doing all three of these things at the same time. They don't have to be consecutive. Once you have eligible payments under your belt, you have those eligible payments under your belt forever, unless you consolidate. Consolidation is the only thing that will wipe out prior eligible payments. And we'll talk more about that as we go. But again, 120 eligible payments on eligible loans while working for an eligible employer. So for example, if you're working for an eligible employer and you are making payments under an income-based repayment plan and those payments are on time, that's not going to count if you're not doing that on eligible loans. And there's no way to make those count. Another example is you might be on an income-driven plan or another type of eligible payment option. You're making those payments on direct loans, which are eligible loans, but you're not working or you're not working full-time for an eligible employer. Those payments can never, ever count, no matter what. So again, all three prongs, all of them at the same time, but they don't have to be consecutive. So let's talk about what an eligible loan is. The short answer is a PSLF eligible loan is a federal direct loan, full stop. Any federal direct loan, Stafford loans, Graduate Plus, Parent Plus loans. Now that's something a lot of student loan consumers aren't aware of, is that Parent Plus loans are indeed eligible for PSLF based on the employment of the parent borrower. It doesn't matter who's actually making the payments. It matters where the borrower is working. Direct consolidation loans also count. Doesn't matter when the loan was made. If what we generally run into with consumers is they're not sure if they have direct loans or FFEL loans or Perkins loans. And the easiest, especially now 11 years in, the easiest way to tell if you have a direct loan is to send them to studentaid.gov and see when the loan was made, or even ask them, did you attend school prior to or take any loans out prior to July 1st, 2010? If they didn't, There's a 99% chance that it's a direct loan. There's this tiny chance that it's a Perkins, but most Perkins borrowers are aware of Perkins versus borrowers not necessarily being aware of whether they have a FFEL or a direct loan. But so anyway, the only loans eligible for PSLF are direct loans, but all direct loans are eligible for PSLF. Now, these loans are not eligible for PSLF. However, they can be made eligible by consolidation. And that's all of your FFEL loans, including a FFEL consolidation, as well as the other federal loan programs, including Perkins, the old HEAL loans, the health profession student loans. All of those can be made eligible for PSLF once consolidated. And of course, the only place to get that consolidation is at studentaid.gov. What's super important to remember, and I'm going to say this a million times throughout this presentation, is that if you need to consolidate to become eligible for the program, you need to do it sooner rather than later, because like I said on that very first slide, any payments made prior to consolidation can never count. There are 0 exceptions. There isn't a person on the planet that can or will make an exception to this. So any payments made prior to consolidation will never count towards PSLF. So if you do have a FFEL loan or a Perkins loan or a HEAL loan, and you need to consolidate to access PSLF, you need to do it sooner rather than later. And then, excuse me, unfortunately, I've run into my fair share, probably more than my fair share, of borrowers over the years where they don't realize that they have a FFEL loan, or they don't realize that the FFEL isn't eligible until after they've already cut the 10 years under their belt. And at that point, when you tell them they need to consolidate and start all over again, you need to have a further conversation to make sure it's worth it. How much do they have left on their balance? Is it, if they consolidate and start the 10 years all over again, based on their income and anticipated income, is it anticipated that they'll get forgiveness, or will they end up paying the loan off at that point? So you need to do a balance to see, is it worth starting all over again if unfortunately they don't find out until it's almost too late. Private loans, state loans, institutional loans, any other ways of paying for college can never be eligible for PSLF. So again, direct loans are the only loans that are eligible. The other federal loan programs can be made eligible through consolidation into the direct loan program, and other loans cannot be eligible at all. Do we have any questions about what an eligible loan is?
Nothing in the chat so far.
Okay, great. All right, let's talk about what an eligible employer is. This is where I think people tend to get the most, they tend to trip up the most. The number one thing to remember, and this is one of those myths that is still out there with consumers, is for PSLF, it does not matter at all what you do for a living. It 100% matters who you work for. Now, where I run into this often are people that work at, say, a public school system. So let's look at the Boston public school system. So I can pretty much guarantee you that the majority of the teachers that work at the Boston public school system are, if they have student loans, they're aware that their loans are PSLF eligible. But who often isn't aware that their loans are also PSLF eligible are the people that work in the cafeteria, the custodians, the administrative assistants, the principal. All of those people are potentially eligible for PSLF because they work for the Boston public school system. Same thing with hospitals. The doctors and the nurses almost are always aware, but the people that work in the gift shop, the cafeteria workers, custodians, other administrators, they often aren't aware that they're potentially eligible for PSLF. You do have to be full-time, and full-time is as it's defined by your employer. Now, you can also be part-time as long as you're working for multiple eligible employers for a minimum of 30 hours a week. Now, I want to clarify this because sometimes people read this to mean that as long as they're working 30 hours a week, period, it counts for PSLF, and that's not true. If you're working for just one PSLF eligible employer, and let's say they define full-time as 40 hours a week, and you're working 35, that does not count for PSLF purposes. You could make it count by doing one of two things. You could either pick up another 5 hours at that employer and be working 40 hours, or you could just pick up a single hour at another PSLF eligible employer. So now you're working at least 30 hours a week for multiple PSLF eligible employers. Now, to verify that, the best way to verify that your employer is eligible is to submit what we used to call the employment certification form. Now, a couple months ago, there used to be a separate form for certifying your employment and a separate form for actually applying for forgiveness once you've made the 120 eligible payments. But a couple months ago, the Department of Education issued a new form that covers all the things. It's your ECF, it's your PSLF forgiveness application, and if needed, it's your TEPSLF application. Just for clarity purposes, when I'm talking about employment certification, I'm still going to use the term ECF for employment certification form, but just know that there is only one form. And if you go looking for it, that's the form you're going to come across, is that combined form. So the best way to verify that your employer is eligible is to submit your ECF form. I can't encourage you enough that if you're pursuing PSLF, that you submit your ECF forms early and often. And by often, I mean at least once a year. Now, to be clear, you're not required to. You technically could skip along for the 120 payments and not submit your proof of eligible employment until the end, and you submit it all 10 years at once. That is a terrible idea. It's a terrible idea for a couple reasons. Number one, you're not going to be 100% assured that your employer is eligible until you submit the form and they send you the thumbs up letter saying, yep, we're showing that this is eligible employment. And then they start counting the loans move over to the PSLF servicer, which is Fed Loan Servicing, and they start counting your payments. The other reason it's a terrible idea to wait is the current record keeping protocols that many employers have. You know, back in the day, most companies kept everything forever. And these days, the protocols and the recommendations is to get rid of data and information as soon as you can for liability reasons. It's for information security reasons and other liability reasons. So I would, and I've actually run into this once or twice, where somebody goes back to a prior employer that they worked at, say 8 or 9 years ago, and ask them to certify the employment, and they can't because they only keep employment records for say 5 years or 7 years, so they don't have the records anymore, and therefore don't feel comfortable certifying that prior employment. The third reason to submit your ECFs early and often is, I'm sure you've heard, and if you haven't, you will hear it from me. One of the biggest issues, operational issues right now with PSLF is what we call the payment count issue, where the payment count showing up that Fed Loans is showing is different from what the borrower thinks they should have for eligible payments. And I would say easily 80% of those payment count issues stem from scenarios where the borrower accrued potential PSLF eligible payments at a prior servicer. And then they submit their ECF, and then the loan goes over to Fed Loans. It's not that they won't or can't count the prior servicer payments. It's just that it's really hard. And that's where the errors come up. And you can ask for a recount. You should ask for a recount if you feel that it's wrong, but you should know, and I am not by any means exaggerating, that the timeline to get a recount right now, and it's been like this for a while, is over a year. So to avoid that sort of anxiety and concern about payment counts, if you're pursuing PSLF, get your loan over to Fed Loans as soon as you can. And the easiest way to do that is to submit that first employment certification form. The reason that it's so hard, we have this kind of kerfuffle about prior servicer payments, is most of these servicing systems were built 20, 30 years ago, maybe even longer, before PSLF or even the income-driven plans were even a twinkle in a congressperson's eye. And these systems, most of them are homegrown. So think about it this way, like Fed Loan system speaks French, and Navient system speaks Spanish, and Nelnet system speaks English. So it's not as simple as them transferring the records over and their servicing system being able to read them. They almost always have to be hand counted. They have to go through the archives to find the paperwork to verify that the whether the payments are going to be eligible. And that's why we oftentimes end up with these payment count issues. So again, um, get your ECFs in sooner rather than later. Now, another recent development is the Department of Education has enhanced what we call the PSLF tool in the last few months. It might have been 4 or 5 months ago now. What they did is they bumped the PSLF tool up against the database, the internal database that they have that contains all the employers that they've already approved in the past. So if you go to the PSLF tool and fill out your employment certification form through the tool, and your employer has already been approved because another borrower or maybe even you in the past has already gone in and gotten it approved, things are going to go a lot more smoothly for you. The ECF form is more likely to be approved without any errors and more quickly. If where people get confused, especially government employers, is they go to use the PSLF tool and and like, oh, I work for the state of Massachusetts because I work for UMass. And I go in and I put in I put in UMass's information, and UMass pops up, but it's a completely different address from where I work. It's an address in Boston, for example. You should use it anyway, even if the physical address doesn't match. What really matters is the EIN number, and the EIN is going to be the same for multiple, for everybody who works for the state of Massachusetts, for example. So don't worry if the address doesn't match. I still encourage you to let the tool pre-populate the form for you. And by the way, EIN stands for Employer Identification Number. It's an IRS number that's used to identify various employers, and it's what the Department of Education uses oftentimes, most of the time, to verify whether an employer is eligible at all. All right, so an eligible employer is any government employer. Now that's federal, state, local, or tribal. That's full stop. If you work for the government, you work for an eligible employer. You don't have to check off any other boxes. Now, where people get confused is if they work for a contractor. Contractors are often private companies and therefore not eligible for PSLF. Unfortunately, even if you every morning, minus COVID, I suppose, walk into a government office, sit at a government desk, answer a government phone. You are, if that's not who is issuing your paycheck, if you work for a contractor, unfortunately, that could not be considered PSLF eligible employment. You need to be directly employed by the eligible employer. On a related note, for government employment, you also could be serving full-time in the military, be in the Peace Corps, or part of AmeriCorps. All that counts as working for an eligible employer. Any 501c3 nonprofit is also an eligible employer. And again, that's a full stop. You don't need to check any other boxes. Where it can get a little murky is if you work for a nonprofit that's not a 501c3. Now, if you work for a nonprofit that's not a 501c3, it's not impossible that they could also be PSLF eligible employers. They can be if their primary purpose of being, not a side hustle, but their primary purpose of being is one of the bullet points you see in front of you: public interest law, public library services, public health. If their focus is one of those things, then that can also be considered a PSLF eligible employer. Now, where it gets even trickier, however, is that despite the fact that these bullets all look pretty clear, they're not necessarily as clear as they look. The definition, that the regulatory definition of some of these items are not necessarily intuitive. The example I like to use is public interest law services. You might remember there was actually a court case about this very thing way back when forgiveness first started to happen. It was a court case between the American Bar Association and the Department of Education. employees of the ABA, which is a nonprofit, but it's not a 501c3. They assumed they would be eligible. They actually were initially told they were eligible, and then a couple years in, they were told, I'm sorry, you're not, the ABA is not an eligible employer. And, at face value, you might say, well, why not? It's the ABA. That appears to be public interest law. Why wouldn't it apply? Well, the regulatory definition of public interest law is an organization that gets at least some of its funding from the government. And the ABA doesn't, or at least didn't at that time, get any funding from the government at all. So especially if you're working for a non-501c3 nonprofit that you think might be eligible, it's super, super important to submit that employment certification form and verify that you are indeed working for an eligible employer. Non-eligible employers that can never be eligible no matter what are labor unions, partisan political organizations, for-profits, or non-501c3s who don't provide a qualifying public service like we talked about before. I want to get back to just for a minute, the whole contractor thing. What I used to say for that piece is that it matters who issues your paycheck. And that is not 100% true anymore. There are some scenarios where the organization issuing the paycheck is not the hiring organization, so to speak. So that's why now I say it matters who you work for. 99.999% of the time, what matters is who issues your paycheck. But I am aware of some scenarios where there are circumstances where the organization that has the hiring and firing power is not the same that is on the paycheck. Apparently, what's that big payroll service that we've all got paychecks from at some point in our lives? Is it ABT? ADP. So ADP apparently also has some other service where if you look at that person's paycheck, it looks like they actually work for ADP. ADP's EIN number is actually the one on the paycheck showing as the employer. But that's not the case. I'm not entirely clear what this makeup is, but I have been able to clarify with the Department of Education that, let's say TISLA had this type of arrangement with ADP, even though my paychecks were coming and it looked like ADP was my boss, and when in fact ADP has no firing or hiring authority over me, it's TISLA that would have hiring or firing authority over me. So therefore, it would still be considered eligible. That again it's an outside thing. You probably will never run into it, but I wanted to make sure you're aware of it. If you ever do run into it, reach out to me. I actually think we have some discussion of it on our website under PSLF. It'll tell you exactly what to do to make sure that you get credit for that qualifying employment. Are there any questions about what a qualifying employer is?
So Betsy, nothing coming in on the qualifying employer, but we did get, could we go back a little bit to the counting and the servicer? We did get a question about that.
Yep, okay, what is it?
So Marianne was told that her servicer does not count. And I'm happy to let her ask the question. That's all it says is Marianne was asking about her servicer not counting payments, and I'm happy to let her unmute and ask the question if she wants to.
Well, I think I probably understand. None of the servicers other than Fed loans count PSLF payments. None of them do. The only way to get them to start counting is get the loans moved over to Fed loan servicing, which the way you do that is by submitting that proof of employment. So what they do, once the loan transfers over to Fed loan servicing, all your prior records also transfer over. And because the other servicers aren't counting PSLF payments, Fed loans has to count them. And it can't just be done by the system. The system doesn't do it in most cases automatically because, as I explained, they essentially don't speak the same language. So that's why we tend to have payment count issues, especially if people spent a lot of their PSLF eligibility time at a prior servicer. And if I did not answer your question, Feel free to take yourself off mute and let me know.
Michael had a question as well. He wanted to ask an employment question if Michael wants to ask.
Hi, Betsy. Michael Silverdale. The question I have is one that you've probably answered a zillion times in the past, but is one that I always struggle with, which is, what about organizations that are not for profit, but they're international organizations like the world, like the UN, for example, where the UN arguably performs a number of those functions that are listed as on that list you provided, and they're not for profit. But I've been told, or at least I've heard at different venues, there's been some suggestion that those types of organizations would not qualify. Could you clarify?
Yeah, and I would argue too, using your example, that the UN doesn't qualify because the UN, their primary purpose for being is not one of these things.
Well, but except for, and maybe I misread it, but the ABA case you mentioned, for example, I thought that the ultimate legal outcome was that since the actual regulatory language did not include the word primary, that they actually overturned that piece of it. And that it was because the original regulatory language just says performs one of the following, and the word primary was added later as a regulatory interpretation. And I thought that got overturned.
It got overturned partly because of that, and partly because they ended up determining that there was something to be said about the fact that they were told in the first place that they were eligible. But since then, the Department of Education has made it clear that it does have to be the primary purpose.
Okay, thanks.
So, maybe if back in 2012, you submitted an ECF and we're told okay, and it wasn't a primary purpose, you might have an argument. But you might have to take it to court to get there. But the department has made it very clear since then that it does have to be their primary purpose.
Okay, thank you.
Mm-hmm. All right, a couple other things to remember about eligible employment is you have to be employed at an eligible employer full-time at the time you make every single one of those 120 PSLF eligible payments. It's not a PSLF eligible payment unless at the time you make the payment, you are working for that eligible employer. Now, the reason I emphasize that is, let's say your payment due date is the 1st of the month, and you leave your old PSLF eligible job on the 30th of the prior month, and you don't start your new PSLF eligible job until the 7th of the next month, but you actually make your payment on the 1st, that payment's not going to count. You'd have to make it either on the 30th or on the 7th. You'll see when we get to eligible payments that an eligible payment is one made within 15 days of the due date. So you are able to do that. But what matters is that you were working for the eligible employer on the day you made the payment. You also have to be working for the eligible employer at the time you applied for forgiveness. And this is fairly new, meaning this didn't really come out as guidance until 4 or 5 years ago. You have to be working for the eligible employer at the time the government reviews your forgiveness application. So when they clarified this, I just my heart sunk a little bit. I could just visualize somebody who hates their job. They're waiting to make their 120th payment and submit their application, and then they rage quit in a dramatic and public way. If you are one of those people, and I hope that you're not, but if you are one of those people, please do not rage quit in a public and dramatic way until you get the letter in the mail stating that your loan has been forgiven. I actually have someone, a very, very frustrated someone that I've been working with through TISLA, who has been waiting for 3 months to get her, letter in the mail because she knows that she can't leave her current job, but she can't leave her current job quick enough. And she's furious that it's taking as long as it has for her to get the forgiveness. So I have a feeling she will be publicly and dramatically rage quitting when she does finally get that forgiveness letter in the mail. You do not have to work for the same employer for the entire 120 payments. You do not have to have consecutive eligible employment. Remember, the only thing that can wipe out prior PSLF eligible payments that you already have under your belt is by consolidating. Nothing else they'll always be there waiting for you. And you don't have to have consecutive eligible payments. One thing we run into often in the university system is apparently it's very common or almost exclusively that no matter how many hours they actually work, adjunct professors are never classified as full-time by their universities. And I've had worked with a lot of angry adjuncts that, you know, I work 50 hours a week, but the school doesn't consider them full-time, and therefore the school won't certify them as full-time, and therefore their time there can't count for PSLF. I'm not sure why that is. I'm hoping it can change at some point, but it's something that we run into fairly often. Anything else about eligible employment before I go to payments?
We got one that came in. Regulations now include allowing faith leaders to be eligible for PSLF. Do you have more information on exactly which positions like that qualify?
So just as a reminder, it doesn't matter what you do. It matters who you work for. Now, up until recently, it's true that any time spent working in religious activities, such as teaching religion or giving sermons, for example, you had to exclude that from your hours work. So let's say your employer was an eligible employer, but you worked, they considered full-time 40 hours a week, but you spent 5 hours teaching CCD classes. That would mean that you could only count 35 hours, and therefore that time wouldn't be considered eligible for PSLF. In order for you to use that time to be eligible for PSLF, if you were teaching 5 hours of CCD classes, you would have had to work a total of 45 hours. So you could subtract that 5 and meet the employer's definition of full-time. Due to a court case between the Lutheran Church of Missouri and the Department of Education, you no longer have to exclude time spent on religious instruction or other religious activities from the number of hours that you worked. So using my same example, if you're working 40 hours a week and the employer considered 40 hours full-time and you spent 5 of those hours teaching CCD classes, now you're okay. It's still considered 40 hours. But again, I want to reemphasize, because of the way that person asked the question, what they asked was, what positions does that mean? Doesn't matter what your position is. It matters who you work for. Okay. Let's talk about eligible payments. An eligible payment is one that's made on time. Now, on time is defined as within 15 days of the due date. Now, up until recently, that was a pretty strict criteria, and therefore you could not make a lump sum payment and have it count for anything more than a single month's worth of PSLF eligible payments. Well, the Department of Education has recently changed that rule, and now lump sum payments can possibly count for multiple months of PSLF eligible payments in limited situations. The way they've defined it is that if you make a lump sum payment, it can count towards the lesser of 12 payments or until it's time for you to recertify your income-driven plan again. So for example, let's say your payment is $100 a month. In January, you send $1,200. That payment can either count for the next 12 months, so to bring you through to the next December, or if, let's say, you renew your income-driven payment plan in June, in that situation, that $1,200 payment you made in January would only count January to June. Now, when they made this change, people got all excited about it. But if you take a step back and think it through, this is really only helpful to a really limited number of borrowers. You cannot get PSLF any faster with lump sum payments because you still have to prove that you're working for an eligible employer at the time the payment counted. So if you in January make a $1,200 payment, those 12 payments aren't going to count for PSLF until you submit that employment certification form after December, proving that you worked for an eligible employer for those prior 12 months. So again, you're not going to get PSLF any quicker. The only people this is really helpful for Excuse me. If you work for an employer that makes student loan payments on your behalf, oftentimes they're making those payments quarterly or twice a year or even once a year. So what was happening before is, the borrower got this benefit where their employer was making the payments but making them quarterly. The borrower was still having to pay for the other 3 months in that quarter because that lump sum payment could only count for the single payment. Well, now in those scenarios, those lump sum payments can potentially count for multiple payments. But again, it's not going to get you PSLF any faster. Only payments made on or after 10/1/07 count for PSLF. Payments made while in default will not count for PSLF. However, if you had PSLF eligible payments under your belt and then you defaulted, assuming you don't consolidate out of default, those payments will still be waiting for you once you rehabilitate the loan and it's back in good standing and you start accruing PSLF payments again. They only count if they're made while working for full-time for an eligible employer, and they only count if they're made on a federal direct loan. Remember, all three of those prongs at exactly the same time. And it doesn't matter who actually makes the payment. So in the case, again, of a Parent Plus loan, a lot of families have a sort of agreement set up where the student is making the payments, and that's fine. As long as it's the parent borrower who's working for the PSLF eligible employer. Now, this is really exciting. So the COVID waiver period, which, as a reminder, what the COVID waivers do is for federally held federal student loans, and they've actually opened, just as an aside, and I'll talk about this at the end, they've opened that up a little bit to defaulted commercial FFEL now. But for PSLF purposes, under the COVID waivers, no payments are due, and they have a 0% interest rate. And that's effective as of March 13th, 2020. And as of right now, goes through September 30th of this year. And for those that are wondering, unless things really go backwards with COVID, I do not see them extending this any further. So despite the fact that no payments are due, this period of time, assuming that you're still working for an eligible employer, this period of time counts for PSLF. Again, assuming that you're still working for an eligible employer. Now, this sounds too good to be true. And a lot of PSLF borrowers just didn't believe it because it did sound too good to be true. So they were making payments anyway. If you're one of those people, or if you know one of those people, stop it. Not only are you not doing yourself any good, it's not going to get you PSLF any faster. They're not going to count it as 2 months. You're essentially taking that money. You might as well take that money and flush it down the toilet. So the good news is that you can ask for a refund. Any payment made after March, on or after March 13th of 2020, if you call and ask for it to be returned to you, they will, and they actually do it pretty quickly. As of the end of last summer, the Department of Ed issued some data, and there was some 800,000 people who had approved employment certification forms on file, which tells us they're pursuing PSLF, that were continuing to make payments during the COVID period. That's almost 1 million people. So again, if you're one of those people, stop it. Now, an eligible payment is one that's made under an eligible payment plan. And an eligible payment plan is any of the ones that you see in front of you. That could be the 10-year standard, IBR, whether it be old IBR or new IBR, pay as you earn, revised pay as you earn, and income contingent repayment. Now let's put a pin in ICR for a second, because I want to talk more about it in a minute. 10-year standard repayment plan counts. But if you make all 120 payments under the 10-year standard repayment plan, you're going to pay the loan off. So if you are on the 10-year standard, you're going to want to get on an IBR plan. I mean, if you're pursuing PSLF, you really want to get on an IBR to really get the benefit from it. Now, where people got confused is that if you consolidate your loans and you don't pick another payment plan, they're going to put you on the quote unquote standard plan. So there's a lot of people that thought they were on track. In fact, there were some servicers way early on that even may have told borrowers that that counted because it was called the standard plan. But the consolidation term is somewhere between 12 and 30 years, depending on how big your balance is. And it's only the 10-year standard plan that counts for PSLF purposes. So if you have a consolidation loan, you want to make sure that you're on an income-driven plan. Now, getting back to ICR, Parent Plus loans, as I've said a couple times, are eligible for PSLF, but it's sort of a catch-22 because Parent Plus loans in and of themselves are not eligible for any of the income-driven plans. So, and of course, if you do 120 payments on the 10-year standard, you're going to pay the loan off. So in order to benefit from PSLF, if you have a Parent Plus loan, you have to consolidate, because once you consolidate, you become eligible for ICR and only ICR. So anybody who has a Parent Plus loan that's pursuing PSLF, they need to get on, they need to consolidate sooner rather than later to get on ICR. Now here's another little loophole. It unfortunately isn't going to benefit a lot of people, but I want to make sure that people are aware of it. If you're able to double consolidate your Parent Plus loans, and I'll explain what that means in a second, you actually can open those loans up to the other income-driven plans, old and new IBR, pay-as-you-earn, and revised pay-as-you-earn. And that could be important because ICR tends to be the more expensive of the income-driven plans. Old IBR uses 15% of your discretionary income. New IBR, pay-as-you-earn, and revised pay-as-you-earn, they only use 10% of your discretionary income. ICR uses either 20% of your discretionary income or this other calculation, which is fairly complicated in a whole other webinar. But most of the time, ICR tends to be the more expensive. So the way someone could double consolidate, they'd essentially have to have their own student loans in addition to Parent Plus. So the way you would do it is you would consolidate the Parent Plus, just the Parent Plus, and then you would consolidate again with loans other than Parent Plus. And that would essentially get rid of the quote unquote Parent Plus taint. And therefore that new consolidation would be eligible for all the income-driven plans. So again, that's only going to really work for someone who also has Stafford loans or Graduate Plus loans, or even Perkins loans in their own name from going to school. Now, you don't have to be on the same plan for all 120 payments. And again, they only count if they're made on a direct loan while you're working full-time for an eligible employer. Questions about what an eligible payment is?
So Betsy, we got one that came in that says the confusion around which income-driven repayment plan would qualify to a married borrower when they want to use their own income if they file their taxes married but filing separately. Is there a way to clarify that?
Yeah, so you can use only the borrower's income if they're married and filing your taxes separately for all the income-driven plans except repay. Repay requires spousal income no matter how you file your taxes, with the only exception being in cases of, say, domestic violence. So all the other ones you can file separately and only use your income. I also want to clarify, if you live in a community property state, the way they do it is they split the income down the middle. So let's say you made 40 grand a year and your spouse made 60 grand a year. If you do married filing separately, they're going to attribute 50 grand in income to you. I'm oversimplifying it, but it's something to know. Now, if both spouses have federal student loans, they can both get on an income-driven plan. And not only will they take both incomes into an account, but they'll also take both loan balances into account. And oftentimes, that scenario is what ends up having the lowest payment total for the household. So just because you're married and you're pursuing PSLF, don't automatically assume that the best strategy is to do married filing separately. You're going to want to run the numbers and see if it makes sense for you both to get on an IDR and continue to file as married and also take the advantage of the extra benefits and deductions tax-wise that you get from filing married.
We got another one that came in real quick if you want. Do the payments count if the person is a student but working full-time as a teaching fellow, but they're not in repayment status because they're still in school?
The answer to that question is absolutely not. Remember, you have to be on an eligible payment plan for the payment to count. And you're not on an eligible payment plan if your loan is deferred. Any questions about PSLF at all? I'm going to talk about applying in a little bit, but any questions about PSLF eligibility at all before I get into the TEPSLF?
I think we're good.
All right. All right, so the temporary expanded public service loan forgiveness, or the TEPSLF, otherwise known as the PSLF fix. So I sort of mentioned this before. Congress recognized that way in the beginning, I'm talking like when PSLF was first written into law in 2007, and up until the Department of Ed and the servicers really started to promote and put out information about PSLF, which unfortunately didn't happen, really start happening until 14, 15, 16. There were borrowers that were given incorrect information about what constituted an eligible payment plan. Mostly what they were told, as I mentioned earlier, is that the standard consolidation plan counted when in fact it didn't. So what Congress did is they created back in 2018, they created the TEPSLF. And what it does is it allows alternative payment plans, meaning the graduated repayment plan, the extended repayment plan, or the standard consolidation plan to count for PSLF purposes. Nothing else changes as far as the eligibility goes. You still have to have a direct loan. The payment still has to have been made on a direct loan. It had to have been made on time, and it had to have been made while you were working for an eligible employer. So nothing else about the sort of the three prongs of eligibility changes. All it does is expand the type of repayment plan that potentially counts for PSLF. Unfortunately, they made things a little complicated. So in addition to, so you still have to make the 120 qualifying payments. You know, some or all could be under the standard consolidation, graduated or extended. Now here's where it gets tricky. You also have to make sure that your 12th to last, as well as your last payment, have to be at least as much as you would have paid under an income-driven plan. Now, the easiest way to do this is, once you know you have at least 111 payments, is to get on an income-driven repayment plan for the last 12 payments. And then you know that you'll meet this criteria for the TEPSLF. However, that doesn't necessarily make a lot of sense if, let's say, you've been paying under standard consolidation, and your payment amount under standard consolidation is $300 a month. And then you run the numbers, and the lowest payment you could get under any of the income-driven plans is $1,000 a month. Why in the world would you want to pay $1,000 a month for 12 months when all you really are required to do is pay $1,000 for that 12th to last payment, and then $1,000 for your last payment, and you could make your regular $300 payment along the way. So if your IDR works out to significantly higher than what you're currently paying, I would suggest running the numbers, not getting on the income-driven plan, paying that higher amount, and to be on the safe side, round up, and like round up generously. So if your lowest IDR payment comes out to, you know, $547, I'd pay $600 for that 12th to last payment, and then run your numbers again in case your income has changed on that last payment, and make that last payment in that higher amount as well. Unfortunately, there are still a lot of call center representatives at the servicers that are telling borrowers that they have to be on an IDR for those last 12 payments to count. I'm here to tell you, I have it in writing from the Department of Education that you don't actually have to be on an income-driven plan for it to count. Now, the TEPSLF is limited. Congress has budgeted $700 million for the TEPSLF. It's first come, first serve, and once it's gone, hypothetically, it's gone. You can't like take a number. You can only apply once you've reached your 120th payment. If you only have a year or two of ineligible payments under your belt, I would strongly recommend getting on an income-driven plan now. I would not count on their money being available 8-9 years from now. But if you have 7 or 8 years of payments under your belt that were all made under the wrong plan, and your income-driven plan amount is going to be a lot higher than what you've been paying, it's probably worth the risk to just stay on the plan that you're on and just worry about that 12th to last or last payment. Any questions about the TEPSLF before I get into the application process?
Nope, I think we're good.
All right. All right. So to apply for either the TEPSLF or public service loan forgiveness, you need to make sure that you've submitted 10 years worth of employment certification forms, whether you've been doing it right along like a good doobie or whether you do it all at once. Either one is fine. When you submit your first one, they will transfer the loans over to Fed Loan Servicing. And as I've explained, that's really the ideal. And then they're going to start counting your eligible payments. After you've reached 120, you want to submit the actual forgiveness form. Now, the forgiveness used to take around 60 days. It was happening fairly quickly. Now it's taking 4 to 6 months. And there's sort of 2 prongs to the process. One is that Fed Loan Servicing does the initial approval, and then they send it over to the Department of Education, who does the final approval. And you do have to wait for the final approval for it to count, so to speak. Now, let's pretend COVID didn't exist and the payments weren't on hold already. They would put you in forbearance during this period, so you're not required to make any additional payments. But if you're not sure if you were eligible, you can choose to continue making payments during that time. Again, not during the COVID period if you wanted to. Any payments over 120 will be refunded to you. That is particularly a nice thing for the TEPSLF borrowers. I've seen some TEPSLF borrowers get pretty big checks back in the mail because they've made well over 120 payments, but they weren't under a quote unquote eligible plan. So that's what I have for you for PSLF and the TEPSLF. Are there any questions at all about either one of these programs before I get into the rest of the stuff?
Chat is still quiet, but feel free to send anything along the way.
Okay. All right. So I just wanted to recap what's going on during COVID and what we can expect or what we should be preparing for post-COVID. So just as a reminder, all federally held federal student loans, so that's all direct loans, and a really tiny portion of FFEL loans, and a really tiny portion of Perkins loans that have been assigned or sold to the Department of Education over the years. So they all get 0% interest effective March 13th, and no payments are due. They're being reported to the credit bureaus as if they were actually in repayment and in good standing. Those months do count for PSLF. They also count for the months needed for income-driven plan forgiveness. They also count for loan, if the borrower is in default, for loan rehabilitation purposes, meaning, normally you have to make 9 consecutive on-time payments to rehab a defaulted loan. Any COVID months count just like the borrower made a payment, even though they weren't making a payment, which could be a good opportunity. They're only counting the months after the date the borrower actually signed the loan rehabilitation agreement. Something that just happened last week is, so there's been, right along, a lot of the advocacy organizations, including TISLA, have been saying to Congress, please include these commercially held FFEL loans and Perkins loans because they're struggling just as much as the federally held borrowers are. One of the things that the Biden administration did, they announced it last week, is they are actually going to extend the benefits to commercially held defaulted loans only. Now, they say they have plans in the works for the non-defaulted loans, but as of last week, they've only announced this for the commercially held defaulted loans. So what they're going to do is the 0% interest rate and the whole rehab thing is going to apply to them retroactive to March 13th of 2020. They're going to return any involuntary, meaning wage garnishment or tax refund offset payments made on those accounts back to March 13th of 2020. If the borrower made voluntary payments, they can ask for them back. And then anybody that defaulted since March 13th of 2020, now this is again only for commercially held FFEL loans, the Department of Education is going to take those loans from the guarantee agencies and put them back in good standing, like they never defaulted. So this of course potentially creates some sort of a moral hazard. Why would, I've already been asked by borrowers, should I let my loan default so I get the 0% interest? And, of course, the answer to that is no. But it also indicates that they must be having something in the works for the non-defaulted FFEL to make sure that this isn't a moral hazard. So that is something new as of last week. If you want more information, there's a press release about it that I'm happy to share with you. One last thing to talk about with COVID is the COVID waivers is that, yes, no interest is accruing as of March 13th of last year. However, a lot of borrowers had interest that was accruing before that, especially if they were on an income-driven plan that didn't satisfy their monthly interest, or if they were in school or their grace period, there's that interest sitting out there in the accrued interest field. Now, any event that would typically cause interest to capitalize is still going to cause interest to capitalize. It's just that the COVID waivers, which normally anytime you go from a non-repayment status to a repayment status, interest is going to cap. The exception are these COVID waivers. But if, say, the borrower was in, discretionary forbearance as of March 12th, that would normally result in capitalization. And when the COVID waivers are over, they should expect that interest that was sitting there to cap anyway. Same for people that were maybe in their grace period. They should expect interest to capitalize anyway. Any questions about the waivers?
So good.
Okay. All right. So this is something we need to worry about. Now, I know that the Department of Education and the student loan servicing centers and the other student loan management participants are doing what they can to prepare for this. But regardless of whether the waivers end on September 30th or at a later date, we're looking at 42 million student loan borrowers entering repayment at exactly the same time. And quite frankly, I just don't think you can staff for that. So I'm fully expecting, my mantra right now is prepare for the worst and hope for the best. And so I'm expecting there to be extended call wait times. I'm expecting it to take a lot longer to process paperwork. So, the messaging to the borrowers is patience. If a borrower feels like that they're going to need a lower payment option or deferment or advice on how to manage their loans, they should be prepared to get that stuff in as early as I would say August. And again, I would anticipate it to take an extra long time to process, and just to have patience. It is what it is. What I'm hoping is that the Department of Education takes a couple actions to help ameliorate the outcome of this potential tidal wave. What I'd like to see them do, and this is something, in my opinion, they could do without congressional intervention, is stop negative credit bureau reporting for a year after the loans go back into repayment, and to stop defaults for a year after, or maybe even a year and a half for defaults after the loans all go back into repayment. I don't know if they're going to do that or not, but I think that's one way to make sure that borrowers aren't negatively impacted by this, but it's something we need to prepare for. So the other thing, especially with this audience, the more of us that can be available to borrowers to help them with counseling, keeping in mind that the phone lines at the servicers are probably going to be really heavy, the better. So, if your institution has a way to, offer student loan counseling services to your alumni, that might be really, really helpful. Now, of course, schools' default rates are going to look great for a couple of years because of this year and a half of non-payment. And by the way, anyone who was delinquent prior to March 13th was also brought current. So not all 42 million of these borrowers are at 0 days past due. But what could happen as a result of this tidal wave is your cohort default rate a couple of years from now could get ugly, especially if the department doesn't take any type of action. So again, if your institution has a way to even just communicate with your alumni to help them be prepared for this and let them know what their options are, that's probably going to be super helpful. Here at TISLA, we're trying to prepare for it too. I'm hoping to bring on additional staff so that we can do additional outreach and we can be another resource to borrowers that are going to need help once they go back into repayment. Ascendium did a survey back when we thought the waivers were going to end at the end of January. Ascendium did a survey of borrowers at the beginning of January, and only 21% of the borrowers they surveyed at that point felt like they were ready to re-enter repayment again. So I'm not trying to be a chicken little here, but I am a little nervous. All right, let's talk about the elephant in the room, which is whether or not the current administration is going to offer broad student loan forgiveness. Now, we've seen a lot of headlines about it, but if you really dig down into the headlines, all it's really been is some Democratic members of the Senate strongly encouraging the Biden administration to offer broad student loan forgiveness, either in the amount of 10 grand or 50 grand. And there was also a resolution that they issued where they made their legal case over why they thought that President Biden had the authority under executive order to do broad student loan forgiveness. And then the other side of this tastes great, less filling has been the Biden administration saying, we don't think we have the legal authority to do it. But we support it. We significantly support it. And we encourage Congress to do it because Congress obviously does have the power to do it. Now, most recently, President Biden instructed Secretary of Education, oh my God, his name's right on the tip of my tongue. Oh my, Betsy, shame on you. Anyway, the guy that's not Betsy, to do another legal analysis and present it to them. And people got all excited about that. And I actually, when I first read it, first thought the tide was turning, but now I don't think so. I think it's just, let's get the final legal analysis. I think the answer is going to be no, that they don't have the legal authority to do it. And then it's going to go back to Congress. Now, technically, if you remember the way the CARES Act waivers started, it was actually through executive order. And technically, former President Trump did not have the authority under executive order to do the 0% interest or arguably the payment pause. But no one was going to argue with him at that point. No one was going to challenge that in court. So the issue is technically less about whether he has the authority under executive order to do it and more about whether anyone's going to challenge him in court. And this proposal is a lot more controversial than giving consumers temporary relief on their student loans during a worldwide pandemic, because this is a significant amount of money that would be on the U.S. taxpayers' back. Even if they only forgave 10 grand per borrower, that's $300 million. That's a big, big chunk of change, even when you're talking about the federal budget. And it's not, even though the Democrats currently hold all three branches of government, this proposal, even to forgive the 10 grand, is not is not something that's accepted even by all Democrats. The problem, and so the chances of it getting challenged in court are much higher than what that executive order with the CARES Act waivers was. And if you think about it, if he was to issue executive order to forgive the 10 grand and didn't feel like he had solid footing from a legal perspective, it could be very chaotic. I mean, I'm already seeing consumers make decisions based on the fact that they're assuming there is going to be forgiveness. So, for example, people that were taking advantage of the 0% interest rate and making, interest-free payments on their loans for the last year or so, they're asking for refunds of those payments. I'm seeing students that are in school that maybe didn't need to take out loans this year. They're taking out loans because, quote unquote, they're going to be forgiven anyway. So can you imagine if they issued this executive order saying everybody, you get 10,000 forgiven and you get 10,000 forgiven. And then it turned out that the court agreed, and it got challenged, and then the court agreed that there wasn't power under executive order to do it. That could be really chaotic. So I sort of get why the Biden administration is really trying to punt this over to Congress to make sure that any such decision is on solid footing. So now let's look over at Congress, whether Congress will do it. So again, the Democrats hold all three branches of government. So I think we are closer to broad student loan forgiveness than we've ever been before. But I still think as of right now, we only have maybe a 10 or 15% chance of that happening. As a standalone proposal, I don't think it has a lot of legs because the fact of the matter is that student loans are the symptom. The issue is the cost of higher education. So I don't see Congress spending $300 billion of the U.S. taxpayers' money to forgive loans that are just going to accrue all over again. Now, with that said, I think if we see a package of proposals that includes some of the policy proposals we've seen floated around already, like double Pell, free community college, debt-free public education for families that make under 125 grand. I think if we see a tiered 10,000 loan forgiveness, and by tiered, I mean based on income similar to what they did for the stimulus checks. I see if we see those things packaged together, I think there's a shot that they could do it. But I don't, again, just my personal opinion, I don't see it happening unless until they package it together and it ends up in a reconciliation bill. So the time to watch is really going to be in the next couple of months. That's when we're going to start seeing some legislation, some bills come up with reconciliation proposals. And if we see, especially the House bill, well, actually, I'm not going to say necessarily, especially the House bill, both, if they contain sort of a package of these proposals, then it could happen. Now, if you owe less than 10 grand on your student loans right now, there's nothing wrong with taking that extra money that you've been planning on paying to take advantage of the 0%, banking it, earning a little bit of interest on it, and seeing which way the wind is blowing come August. And if it doesn't look like they're going to do it, make a lump sum payment at that point. But if you owe more than 10 grand, you should not be changing any of your financial behaviors based on the discussions that are going on right now. Again, that's just sort of my 2 cents. Does anyone have any questions about that or comments or want to say they think I'm completely wrong? I probably am. I just make this stuff up anyway. Nothing?
We got nothing in the chat. I don't know if anybody wants to unmute and speak.
All right. So unfortunately, all this discussion, between the COVID waivers and all this discussion about the quote unquote Biden forgiveness, we are seeing an increased activity level from the student loan scammers. Actually, TISLA, along with 40 plus other organizations, some of which I believe are on this call, we just ended a week-long social media campaign to try to educate consumers about these scams. Called the theme was around April Fool's Day, which those of you that know me know that that's my jam. So it's called #Don'tBeFooled. So, but we are seeing a really significant increase in activity from these scammers. So if you have the opportunity to educate your alumni and existing students about these scams, there is no such thing as the Biden forgiveness program at this point. If and when there ever is one, there will never be a fee to apply for it. It will not be first come, first serve. And they will not need a third party to help them get into it. That's some important messaging to have out there. And that's it. That's what I had. So I think we have another like 10 minutes. People want to ask more questions, even about stuff I didn't cover.
Oh, this
Comment.
is awesome. I was going to say thank you. This was great. I learned a bunch of stuff that I didn't know. I didn't know anything about temporary PSLF, so that was good to know for me.
Yeah, a lot of people are pleasantly surprised when they learn about the TEPSLF.
So we are getting some questions about will we send the presentation out after? We did record it, so the recording can certainly go out. Up to you whether we could talk about afterwards about the presentation itself. Miguel Cardona was the answer we were looking for earlier.
Made me so mad that I couldn't think of it.
Poor Miguel.
Well,
after 4 years of your name being the same, I'm sure, and being mistaken.
God, how happy
for the
am
last
I
one.
that I'm back to being the only Betsy?
You're the only Betsy now.
You don't know how often I was like attacked on social media because they thought I was the other Betsy.
That's
funny. So, going back to the whole Biden forgiveness thing, what I've found really interesting is what I'm hearing from consumers is that they would actually rather have a permanently lowered interest rate than loan forgiveness. The premise being like a lot of them say, listen, if they were going to forgive part of my loans, sure, I'd take it. I'd be tickled. But I feel like I borrowed these loans. I have an obligation to repay them, but it's not a level playing field. I can't catch up because of the interest. So I'd rather see them spend the money on, cutting the interest rates in half forever, which I thought was really kind of interesting.
Yeah, Betsy, this is Michael. I think that I would rather see ultimately the end of negative amortization. If they basically said that you couldn't, if your required payment was less the interest accruing, the interest was just erased. I think that in the long run, that would actually probably benefit more people. I mean, in my own case, for example, by the time my loans were forgiven, I had originally borrowed $90,000. By the time my loans were forgiven, it had increased to $170,000 because of accrued interest. So I think in the back end, getting rid of that kind of interest and negative amortization could be a huge benefit.
It probably would look better on the books too, from a cost perspective. And I think it would help more of the right people. I mean, they were originally talking about doing that 10,000 forgiveness as stimulus, but if you think about it, if you owe 6 figures and you can't afford your loans, you're probably on an income-driven plan. Forgiving 10 grand is not going to put any more money in your pocket immediately, which is what a stimulus is supposed to do. Because your payment on an IDR plan is based on your income. It's not based on your balance. And if you owe less than 10 grand and you can't afford your payment, and they forgive the 10 grand, that's great, but it's not a stimulus. Because if you couldn't afford your payment, if you owed less than 10 grand, you're putting that money to your light bill. You're not using it to go out and buy a new television, which is what they want you to do with stimulus money. So I'm glad that we've stopped calling it a stimulus because, I'm not against student loan forgiveness.
Sorry,
but
I'm on a webinar.
It wouldn't have been a stimulus, in my opinion.
I just can't imagine the revolt of the people who have paid theirs off recently that would come, like if they ended up doing one of the bigger ones where it was, 50 or full or whatever, there would just be so much, I feel like there'd be so much revolt from the people who, recently paid their loans off.
Oh yeah, I hear the angry pants, like, why should you get your loans forgiven if I didn't get mine forgiven? You hear that. But yeah. I hear a lot more saying, you know, it is what it is. I don't think they shouldn't do it just because I didn't get it. So there's a mix out there.
It would be nice if this is Maria, sorry. It would be nice if they at least maybe did something targeted based on income, or, students who went to for-profit colleges that were put in programs and they could never get a job or couldn't finish and that kind of stuff. Those are the people who I feel like really are in a hole that don't need to be in a hole. But I pay my student loans. I borrow them with my own with my own thoughts. I regret it, but now I'm paying them.
Yeah, I don't know. My opinion, and it could end up being wrong, is that they're not going to do anything unless it's a package deal. And when they do it, it'll be tiered like the stimulus checks were. I think that's the only way they would get enough votes. I don't, they would have presented that today. There's no way all the Democrats would vote for it. And certainly the Republicans, I don't think any of the Republicans would. So, all right. Well, if there's no other questions or comments, I'll give you 5 minutes of your lives back.
Well, Betsy, thank you again for joining us and presenting this. This was great. I always keep an eye on not only the chat but the participant list. It never dropped, so everybody was here for the long haul. So thank you everybody for attending. That was awesome. We were unsure about how a virtual event would look, and I think MASFA in general has been doing a really good job at these. So keep a lookout for more events to come from MASFA. And if anybody has any questions or anything after the fact, feel free to reach out to me or Betsy or anybody on GPCC. We're happy to connect you with whoever needs to be connected with.
We'd also love to have you on the GPCC.
Yeah.
Rob and I are both, this is Maria Morelli, I'm the co-chair. Rob and I are both rolling off next year, so we definitely need new members for anybody who's interested.
Yes, GPCC is a good one, especially in non-COVID times where we have our events, and it's nice to schmooze with everybody if that ever happens again. But yeah, definitely always looking for new members, or if anybody wants to take a chair or co-chair role, certainly open to that.
The Government Relations Committee is also awesome.
Yes.
We love new members. All right, I am going to stop sharing my screen.
Yes, and I'm going to stop the recording, so I'll do that. Thank you again, everybody, for attending, and Betsy, thank you again, and I think we can all head on our way.